Hello and welcome back to Principles of Accounting 2. I'm your host, Dr. B. In the last week, we explored introductory to managerial accounting concepts. Most of you did very, very well on the homework assignments. I thought the discussion forums were fantastic. I do want to quickly discuss some of the discussion forum concepts for week one. You all participated in the required discussion forums, which are pretty much all of them, right? The introductions, the scavenger hunt, the 10K selection. I want to make a quick note on the 10K selection. I have responded to each student in the 10K selection process. Well, most of them. There's a few that still need a response that posted last night. With respect to the 10K selection, if you selected a service company, service companies cannot be used for this assignment. A service company would be an airline. It would be a software service, or like a subscription service, an entertainment company. Those are services. They don't carry inventory on their balance sheet. The company that you selected needs to carry inventory on the balance sheet. I cannot stress that enough. Why, you might be asking? The reason why is because the company you will analyze in the 10K statements, you will be performing some computations on the balance sheet, and the company needs to have inventory for those computations to work. The primary difference between financial accounting and managerial accounting is in managerial accounting, we focus on retail and manufacturing companies that carry inventory, and we analyze that inventory. So that's why it's super important that the company you selected, it has inventory. So that's one housekeeping note I wanted to quickly say. Second note, you probably already realized this. We went through some updates for Accounting 202. I'm sorry, 220. 221. Sorry, 221. In Accounting 221, weeks 2 through 8 changed slightly with respect to where things are located. The reason for this change is there were some errors in the content from weeks 2 through 8 that we identified, and some of the homework assignments as well. So weeks 2 through 8 were modified slightly to be more reflective of what the course offering is supposed to have. And the administration helped us change weeks 2 through 8. So everything is correct now, which is good. So just continue as you are. If you have questions on any of the content at all throughout the course, please let me know. I'm here for you. I'm responsive, and I'm also responsible. So please make sure that if you have any questions at all, just let me know. I'm here for you. Even if it's a question on the homework and you're like, hey, Dr. B, I really don't understand this question. Can you elaborate on the content a little bit further? Yes, I will absolutely do that for you. Okay, so we're in week 2 now. Week 2, we are required to cover long-term assets, statement of cash flows, and financial statement analysis. Some of this may be a little bit more review than for some of you who have taken Principles of Accounting 1 or Financial Accounting at another institution. Here at UMGC in 221, we cover statement of cash flows a little bit deeper than other institutions do. And so today's session, we're going to talk about long-term assets, statement of cash flows, and financial statement analysis. And we're going to be doing a deep dive on those concepts. So let's go ahead and get started. And as always, for those of you who have joined me today, if you have any questions along the way, please feel free to interrupt and ask. I'll be happy to take your questions as you think of them. Okay, and of course, I'll also be sharing the recording and these slides as well in the discussion forum and through email. Okay, let's talk about long-term assets. Long-term assets, what are they? This we long-term assets is also called fixed assets. Fixed assets are assets that the company has that help the company to generate revenue. Okay. Fixed assets include property, plant, and equipment. Property, plant, and equipment. That's what a fixed asset is. That's what long term assets are. Think of in your personal life, you probably have fixed assets. You have a home and you have an automobile. A home and an automobile. Those are fixed assets. Why are they fixed assets? Because personally, for you, a home is a long-term, long-lived asset that may or may not appreciate in value, and a vehicle is used to help you to generate revenue or income, and that is also what we consider to be long-lived. When you hear me say the word long-lived, it usually means at least a couple of years or more for that asset's longevity. And a lot of that is actually dictated by the IRS. The Internal Revenue Service provides schedules on how long things should last, believe it or not. So, interesting thing. Okay, so long-term assets or fixed assets are things like property, plant, and equipment. From an accounting perspective, we focus on property, plant, and equipment when we talk about fixed assets because property, plant, and equipment help the company to generate revenue. There are other fixed assets that exist, but when we talk about fixed assets, we're talking primarily about assets that are tangible. You can physically touch them. They are owned by the company and are used in the company's normal day-to-day operations to help the company to generate revenue. They are typically not offered for sale as a part of normal day-to-day operations. In other words, if a company is in manufacturing, they typically don't try to sell their machinery for revenue as a part of their day-to-day operations. Their day-to-day operations is to use that machinery to help them to generate revenue. There are costs, of course, associated with all fixed assets, with pretty much everything we do in business. But there are costs that are typically incurred with any fixed asset. And a fixed asset an asset is typically classified as a fixed asset, an investment, or as an expense. We're going to talk more about that. How do we classify the cost associated with a fixed asset? First thing we do is we look at purchase price and we look at how that purchase price is recorded. If the purchase price is recorded as an asset on the balance sheet, the fixed it is recorded either as a fixed asset or an investment. The difference between a fixed asset and an investment is something that's held onto the company and then is later sold as an investment, right? That's the idea. It's kind of like if you buy gold and you hold on to gold and you sell gold later on because it appreciates in value, that's an investment. Another idea of an investment would be like your personal 10K or retirement fund. That's an investment. Why is it an investment? Well, it appreciates in value over time, and eventually you'll utilize that investment. It's held, but it's not used in day-to-day operations. That's what an investment is. Fixed assets are used in day-to-day operations. So if it is recorded on the balance sheet, then we proceed to step 2. If it's not, it's classified as an expense. In step two, we ask the question, is the asset used in normal day-to-day operations? If yes, it's a fixed asset. If no, it's classified as an investment. These are just steps that help us as accountants to determine whether the fixed asset is classified as a fixed asset or an investment. So, sometimes you might run across a question that might say, the company purchased a piece of machinery as a backup to their current machinery. Is it a fixed asset or an investment? Well, it'll be classified as an investment in that situation because it's not used in day-to-day operations. It's was purchased as a backup. Right? Once in a while, you run into weird situations like that. For items that are classified and recorded as fixed assets, such as property, plant, and equipment, the assets typically last for more than 1 year and are used in day-to-day operations. So remember, anytime you hear fixed asset, think property, plant, and equipment. For investments that are long-lived and are not used in day-to-day operations, they're held for future resale. And these are reported on the balance sheet and they are titled investments. Again, an example would be gold, silver, other commodities that businesses might purchase to hang on to and then eventually sell. It is not as common for companies to carry those types of investments, but some of them do because they know that they can purchase an asset like gold and then later sell it and know that it appreciated in value in most cases. Another example would be, let's say we have a factory and we on our factory we have a piece of land next door that became available for sale, and the factory purchased that land with the potential that the factory might expand over time. And if the company decides not to use that land for expansion, they can later resell that land. That land would be classified as an investment. With any type of investment, there are costs associated with the acquisition of that investment. So here's a couple of examples. We have building, machinery, equipment, land, and land improvements. Building, if you're erecting a building like a factory, you're going to have architectural fees, engineering fees, insurance, interest on any financing for construction, sales tax, repairs, reconditioning, modifying for use, permitting, all of that wonderful stuff. And the list goes on and on and on. This is just pretty much a short example. But there are costs associated with the acquisition of a fixed asset. Same for machinery. Sales tax, freight, installation of the machinery, repairs, reconditioning, insurance, assembly, modification, testing, and permitting. For land, you'll have other examples such as the purchase price, sales tax, permitting, brokerage fees, title, surveying. The list goes on and on and on. For land improvements, the expenses associated with the acquisition of land and the improvement of that land would include things like trees, fencing, outdoor lighting, pavement for parking areas and walkways. So why are we talking about the cost of fixed assets, you might be asking? Cost of fixed assets are very important to account for in the purchase price and improvements on the balance sheet for proper valuation of that fixed asset. There are some costs that do not increase the asset or the useful life of the asset that we need to take into consideration And in the event that these expenses occur, we record them as expenses. They do not increase the value of the asset. These types of expenses would include things like vandalism, mistakes on installation, uninsured theft, damage during unpacking and installing, and any type of fines for improper permitting. There's more, of course. Other things would be like natural disaster that was uninsured, um, whatever. But those types of uh, unintended expenses, they get classified as expenses. Uh, Also, it's important to note that repairs and maintenance that is routine, for example, oiling a machine, putting oil in your car, putting gasoline in your car, oiling the machines, recalibrating the machines, those types of repairs and maintenance that are very normal, those get classified as expenses on the income statement as repairs and maintenance. There are some repairs that would actually increase the useful life of the asset, and that would be something like replacing an engine on your car or on a piece of machinery. That's a major um, upgrade to the asset, and which extends the useful life of the asset. And so that type of repair or replacement in that case would actually increase the value of the asset, and that would actually be recorded on the balance sheet. And we'll talk a little bit about those differences. So here's an example. Our company purchased some equipment for $12,000. The freight of the equipment to ship it to us was $600. Um, the installation cost was $1,500, and there was a $500 error due to the installation. So, how do we compute that? This basically says how much is the equipment really worth. So, when we record equipment, we need to take into consideration not just the purchase price, but also freight and installation. So, how do we compute it? 12,500 for the initial cost for the purchase price. Why 500? You might be asking. Well, 12,000 plus five. The 500 comes from the initial cost that was, I guess, eventually expensed out because of the error. 600 for plus 600 for freight plus 1,500 for the installation. Then we subtract out 500. Why subtract out the 500? Because there was a $500 error in the installation process. So that tells us that our initial cost of the equipment on our balance sheet is 13,600. And of course, we would debit our equipment to increase our equipment on the balance sheet. We would also credit cash to reduce our cash by that amount because we paid that much for our equipment. Any questions so far? It's making sense? You're all okay? All right. Remember, you're on mute, so if you have a question, just unmute yourself. Okay. There are other costs of fixed assets associated. There's direct costs with construction of a fixed asset. For example, let's say you're putting up a building, okay, or a factory. There's going to be materials, labor, that get classified as construction costs of the asset. And if it's in progress, meaning the building is not yet erected, we would classify labor and materials as construction in progress on the balance sheet. It would be a debit to that account and a credit to cash. Then when the construction is completed of your building, you would debit building, credit construction in progress, and credit cash for the difference. Okay, we talked about fixed assets, property, plant, and equipment. And I mentioned that property, plant, and equipment, they have this thing called useful life. Useful life. Useful life is how long we expect to be able to use the fixed asset. Here's an example. Let's say we own a construction company. In our construction company, we have a dump truck. The dump truck cost us $25,000. It has a residual value of zero. Don't worry, we'll talk about that. It has a residual value of zero. According to the IRS Schedule 179, tells us the useful life of this dump truck is 5 years. Okay, so what does that mean? Is the dump truck going to no longer work 5 years from now? Maybe, but it'll probably still be working. We know that over time, the value of assets decreases. Why? Property, plant, and equipment use their usefulness over time because they need maintenance. They need they just over time they just kind of stop working, right? Which that's totally normal. It's kind of like electronics. Over time, they just stop working. Same thing applies with property, plant, and equipment. So because of that, we record this thing called depreciation. Depreciation is the way of accounting for the loss of useful life over time. So going back to my example of the dump truck, we purchased it for $25,000. It has a useful life of 5 years. I could depreciate that dump truck over those 5 years through a different couple of methods. And we're going to talk about those methods. Depreciation is typically caused by physical or functional factors, such as weather exposure, functional factors, meaning it becomes worn out or obsolete. These are the reasons for depreciation. But depreciation happens regardless of these factors. Depreciation happens, it's because it's time bound. It's based off of the usefulness or useful life of the asset. Okay, depreciation is not a measurement of a decline in the market value of a fixed asset. Market value is totally different than the value of the fixed asset. Market value is how much it's worth on the open market. Okay, that that is not a determinant of depreciation. It's not a measure of depreciation. It's a myth, right? People think, oh, that the market went down for that, market price went down for that, so it depreciates by that. No, that's not true. Depreciation is not based off of market values. It is only based off of useful life. There's this thing called book value. What is book value? Book value is the difference between the original cost and depreciation. You take original cost minus accumulated depreciation. That is book value. Book value. Book value is the true value of the asset. Also, depreciation has nothing to do with cash. Depreciation has nothing to do with cash. Depreciation, you'll never see a transaction where you see cash and depreciation together. That just doesn't make sense. Okay, remember, depreciation is the reduction of the useful life or the value of the asset, which has nothing to do with cash. That's another misnomer that people have about depreciation. How do we calculate depreciation, you might ask? And this goes back to my dump truck example, and I'll run through that example a few times. There are three factors that you need to take into consideration when you calculate depreciation. One is the initial cost, two is the expected useful life, and three is the estimated residual value. You might be asking, Dr. B, what is residual value? Residual value is the scrap value. It is how much how much the asset, the fixed asset, will be worth at the end of a project or when it's no longer useful, right? Uh, the initial cost is also known as the purchase price plus all the costs obtained to ready it for use. What does that mean? The initial cost includes the purchase price plus freight plus installation. Okay, the initial cost includes the original purchase price plus freight plus installation. So that makes up the initial cost of the asset. Expected useful life is typically determined by the IRS, Schedule 179. That helps us to determine how long something should last. Although it's most times you'll find that it lasts a lot longer than that, but for intensive for tax purposes, we have a determination of how long things last. For residual value, again, that's how much something is worth after a project or once it reaches the end of its useful life. Expected useful life of a fixed asset is the estimated length of how long we will use it in normal operations. For my dump truck example, I said that it would last for 5 years. So I expect to use that dump truck for 5 years in normal day-to-day operations. It's the estimated time that the asset is placed into service. The estimates of expected useful lives are available from industry trade associations or the IRS. I always go by the IRS. Especially for tax reasons, it's really the best method. What about residual value? It's the estimated value of the asset at the end of its useful life or at the end of a project. It's estimated at the time the asset is placed into service. Residual value is often referred to as scrap value, salvage value, or trade-in value. So think about your car, for example. Your car has a useful life of, we'll say, 5 years. At the end of the 5 years, you're done paying off the loan and all that good stuff. The residual value, and this is where this term trade-in value comes into play. So at the end of the 5 years, how much is it worth, right? You're done paying on it, so there's no loan associated with it. It's worth something. So because it's made out of metal, it still drives, all that good stuff, right? So what's the trade-in value, or what's the salvage value or scrap value? That means, okay, well, it no longer works, but I'm sure the junkyard will take something for it, right? So that's where the terms salvage and scrap value come into play. But as you've probably already know from accounting, there's a lot of terms that mean the same thing. And that's one example of that. Okay. The difference between fixed assets initial cost. Remember, initial cost is purchase price plus freight plus installation. And the residual value is oftentimes called the asset's depreciable cost. This is the asset's cost that's allocated over the useful life as a depreciation expense. For the fixed asset that has no residual value, then it's cost should be allocated to depreciation. We'll talk more about that. How do we depreciate? Okay, there's a couple of different methods that companies will oftentimes use in depreciation of fixed assets. There are three primary methods of depreciation, that is. Uh, a company could use a mix of these methods of depreciation, but it can only be one per asset. What do I mean by that? Let's say I have a dump truck. I purchased it for 25,000. Its useful life is 5 years. It has zero residual value. For that dump truck, I can use straight line depreciation. Let's say I also have a forklift. The forklift I use in day-to-day operations to move pallets of supplies around or inventory. I can use units of activity for my forklift. And then let's also say I have a pallet jack in my warehouse that I use for getting things. I don't know. For that, I could use double declining balance. The point that I'm trying to make here is that you select one method of depreciation for one asset. You can also select another method of depreciation for a different asset. You cannot use two methods for one asset, is what I'm trying to say. So let's look at each of these three methods of depreciation. And these are the three most common methods. There are other ones, but these are the three most commonly used. Straight line. Okay. Straight line means we deduct the same amount of depreciation each year of its useful life. So let's say my dump truck, okay? My dump truck, let's say it costs 24,000. Okay, great. And let's say it has a residual value of $2,000. To calculate straight line depreciation, I take the cost minus residual value divided by the useful life. In my example, it's 5 years. So cost 24,000 minus residual value of 2,000. That, guess what? That's 22,000, right? And on the top part of our equation, divided by 5 years, which is useful life, equals $4,400. Now, how does it work? For the 5 years, I deduct $4,400 each year for 5 years from my my asset. So here's how it looks on the balance sheet. On the balance sheet, you have the asset, in this case, dump truck. Okay, and it'll say 24,000. And they'll always say that, okay? You don't deduct from there. You calculate what we call accumulated depreciation. And you probably learned a little bit about this in the accounting cycle from Accounting 220 or Principles 1. In Principles 1, you learned about this thing called the closing process, right? And you probably also learned about adjusting entries. In adjusting entries, we make adjusting journal entries at the end of each year, or also at the end of each month, but in most cases at the end of each year, especially for depreciation. So at the end of each accounting period, we'll say end of each year, we make adjusting journal entry for depreciation. We debit depreciation expense. That's how we expense it out, right? And we credit accumulated depreciation. When I debit depreciation expense on the income statement, right, 4,400, and I credit accumulated depreciation, 4,400. Guess what? Accumulated depreciation is a asset account on the balance sheet. Asset account on the balance sheet. Now, here's an interesting thing about accumulated depreciation. Earlier, we talked about asset accounts and that they normally carry a debit balance. Accumulated depreciation actually normally carries a credit balance. It's one of the only asset accounts that normally carries a credit balance. So what does that mean? If you have the dump truck at 24,000 on your balance sheet, and then you have, and that's a debit balance, right? And then of course you have accumulated depreciation on there now that has a credit balance 4,400, and that's also for the dump truck. So what that shows us is we maintain the integrity of our original cost, and instead of simply reducing that, which you can't do, we have this line item called accumulated depreciation that carries a credit balance on the balance sheet that represents the depreciation for that dump truck. Does it make sense? Any questions so far? You're all okay. All right, great. So that's straight line depreciation. Let's talk about another interesting one called units of activity depreciation. Units of activity depreciation is the expense for each unit of activity of that asset. It depends on the activity expressed. So, going to my forklift example, I have a forklift in my warehouse. That forklift is run 3,000 hours per year on average. Okay, it's an estimate. It's an estimate. But I estimate that I drive that forklift 3,000 hours per year. That's how forklift is measured, is in hours, not in miles. That'd be silly, right? Okay, so I run my forklift 3,000 hours per year. The unit of activity are the hours. Okay. You can probably see where I'm going with this already. But so instead of, we'll talk about it. But my forklift, on average, 3,000 hours per year is when it's used. Units of activity method is sometimes also called units of production or units of output. It's actually mostly called units of production. But let's look at the example and discuss how it's measured. Okay. So for units of activity, there's two steps. Step one, determine the depreciation per unit. You have cost minus residual value divided by total estimated units of activity. Cost of my forklift, we'll say, is 24,000. Residual value is 2,000. Total estimated use of activity is 3,000 hours. So it's 22,000 divided by 3,000 gives us the depreciation per unit. Okay, that's step one. Step two, we compute the depreciation expense. We take the depreciation per unit that we got from step one, and we multiply that by the units of activity per period. Okay. Any questions so far? That's units of activity. Okay. Great.
Can you go back a little, please?
Yes, no. Yep.
Thank you. I'm good.
Okay, very good. Yeah, anytime you have a question, just let me know. Be happy to answer. Double declining balance. This is the third method for depreciation. This is probably, well, it's a little bit more complex, but it's still pretty easy to understand. Double declining balance, what does it mean? The way it works is for the first year, I double my declining balance. Okay, here's how it works. I got my what did I say I have? Oh, my pallet jack. Okay, pallet jack. So for my pallet jack, I decided to use double declining depreciation. The way it works is that instead, we talked about straight line earlier. That's where you just simply divide the cost minus the residual value divided by the number of useful life. In this case, we actually find a percentage to decline by, especially in the first few years. That's why we call it double declining. It basically shows depreciation happening twice as fast. So how do we figure it out? There are 3 steps for this process. The first thing we do is we determine straight line percentage using the expected useful life. Second thing we do is determine the double declining balance rate by multiplying the straight line rate from step 1, and we multiply that by 2. So in other words, we take the straight line percentage multiplied by 2. In step 3, we compute the depreciation expense by multiplying the double declining balance rate times its book value. Okay, here's how it looks. Well, the good news is we're not going to be tested on it, but it's important that you understand it. So here's how it works. As we compute the double declining balance, the reason why companies do this is for tax reasons. We know that if we depreciate something, we typically get a tax benefit for the depreciation of that asset. That's why you see a lot of companies buying a lot of property, plant, and equipment for their business and then depreciating by some factor because they want to maximize the amount of depreciation per year in order to gain the best tax benefit. It's like a write-off, right? So that's why a lot of companies utilize the double declining balance. But it's very straightforward. You just follow the 3 steps. So comparing the 3 methods, looking at useful life, straight line and double declining are very similar in nature. We use a number of years for its useful life. Units of activity, it's measured by the unit of activity, which are typically something like number of hours being operated or miles driven or some factor thereof. You can actually, what's interesting is you could actually do that for your car as an example and figure out the depreciation of your vehicle using these 3 methods. It's kind of fun. Well, I think it's fun. Okay, the depreciation cost less the residual value for straight line units of activity, and then for double declining balance, it's declining book value. The depreciation rate for straight line is straight line rate cost residual value divided by units of activity for units of activity, and then for double declining balance, it's the straight line rate that you calculated from the straight line method times 2. And the depreciation expense is constant, variable, and declining for each respective method. This chart kind of just summarizes the 3 different methods and compares the 3 together. Okay, that was fixed assets. Any questions at all on fixed assets before we jump into the statement of cash flows? We're going to spend a little bit more time on statement of cash flows and on financial statement analysis. Good so far. Okay. Statement of cash flows. Statement of cash flows, as you hopefully are aware by now, is one of the 4 primary financial accounting statements. The statement of cash flows reports cash coming in and out of the business. Cash coming in the business, we call it a cash inflow. Cash inflow. That's cash coming into the business. A cash going out of the business for expenses, we call it a cash outflow. Okay. The statement of cash flows is categorized into three different areas. Those areas are operating activities, investing activities, and financing activities. We're going to talk about those here in the next few slides, but I want you to understand that the statement of cash flows helps the business to track the physical flow of cash. The physical flow of cash. The cash flow is generated from operations of the business. I get cash coming into my business when I sell services or products to my customers. Cash leaving the business or outflows comes from I'm paying my day-to-day operation bills, like utilities, rent, payroll, et cetera, et cetera. It also comes from a couple of different areas. So I generate cash from operations of the day-to-day business. The cash also helps me to maintain and expand operating capacity, meet financial obligations, and to pay dividends. I mentioned earlier that there are three parts of the statement of cash flows: operating activities, that's the day-to-day operations of the business; investing activities, that's the purchase or sale of property, plant, and equipment; and in financing activities. Financing activities comes from taking out a loan, uh, issuing stock, paying dividends. It's financing. Financing. We'll talk more about that. We use the statement of cash flows as managers to evaluate past operations and to plan for future investing and financing activities. External users are also interested in the statement of cash flows because it helps potential investors to better understand the financial condition of the business. It also helps creditors to understand if they're going to get paid back. And of course, as investors, we're interested in profitability, and if the company has the ability to pay its debts and ultimately to pay dividends to their investors. That's why we're interested in the statement of cash flows. Okay, so the first area that I just talked about is the operating activities. Operating activities stem from the day-to-day operations of the business. Cash coming in, cash inflows, that is generated from sales to customers, whether it be service or merchandise or whatever it is, right? Sales to customers, that's cash coming into the business. Cash going out of the business would be things like you're paying rent, you're paying utilities, other bills, payroll, the purchase and sale of merchandise by a retailer is an example. Just when you hear operating activities, think day-to-day operations. What type of transactions normally happen in the day-to-day operations of the business? And what involves cash, right? The second area on the statement of cash flows is called the investing activities. Investing activities comes from the purchase or sale of property, plant, and equipment. Those are typically the only things that you would find under investing activities is the purchase or sale of property, plant, or equipment. The third area on the statement of cash flows is called financing activities. These are financing options for the business. As we know, businesses raises capital, cash, by two methods: debt and equity. And of course, sales, but sales is from operating activities. If the company wants to expand their operations, they typically need to raise capital, right? They need to raise cash. So how do they do that? They do that either through issuing debt or issuing equity. The issuance of debt means the company took out a loan from a bank, or the company issued a bond for others to invest in. That's issuing debt, yeah? Equity the issuance of equity to raise capital would be the company issued shares of common stock. Okay. Both of the issuance of debt and equity helps the company to raise capital, to raise cash. The opposite is also true in financing activities. The company will also repay their debts. They'll repay their loans. They'll repay their bonds. Okay, hopefully. And the company will also issue dividends to shareholders through equity. So it's an example of cash coming in and cash coming out of the business for financing activities. Any questions so far on the statement of cash flows? How it's organized. I'll be able to show you a photo of it here in a little bit. Good so far. Okay. The statement of cash flows is organized from top to bottom. We have net cash flow of operating activities, net cash flow investing activities, net cash flow of financing activities. When you hear me say net cash flow, NET, cash flow, net cash flow. What that means is it's cash inflow minus cash outflow equals net cash flow. Cash inflow minus cash outflow equals net cash flow. Okay. Cash inflow minus cash outflow equals net cash flow. The way that the statement of cash flows is organized is you'll have operating activities. At the very top, you'll have net income from your operating activities. As you know, net income comes from the income statement at the end of the accounting period. Your net income, then you'll have your cash inflows minus your cash outflows equals your net cash flow for operating activities. Plus or minus, but mostly plus. You'll have your investing activities, your net cash flow from investing activities. That's the purchase or sale of property, plant, and equipment for that accounting period. Then you'll have your financing activities. That is your issuance or repayment of debt and equity. So you add those operating activities, investing activities, and financing activities to get the change in cash. Plus the cash at the beginning of the accounting period equals the cash at the end of the period. We'll talk a little bit more about how that looks. Questions so far? We're okay. We're good? Okay. Statement of cash flows. The source of cash causes the cash flow to increase. We call it a cash inflow. When there's a causation of outflow or decrease, we call it cash outflow. Here's how this just basically defines the difference between cash inflow and cash outflow. Remember, you hear me say cash inflow, that is sources of cash coming into the business. Sources of cash coming into the business is called a cash inflow. A cash flow outflow are sources of cash leaving the business. That's a cash outflow. Here's some examples. Cash inflows from operating activities are the sale of products or services. Cash outflows for operating activities include things like the purchase of inventory. We need to pay our employees. We need to pay our taxes. We need to pay our utilities, our rent, et cetera, for day-to-day operations of the business. Cash inflows for investing activities include things like the sale of property, plant, and equipment, or the sale of an investment. Remember, we talked about investments a little bit earlier. Investments are things that are held by the business, not used in the day-to-day operations, and can be sold later. That's sale of investment. And then we have cash outflows for investing activities. That would include things like the purchase of property, plant, and equipment, or a purchase of investment. And we have financing activities. Financing activities inflow from financing would include things like the issuance of long-term liabilities, issuance of debt, right? Or issuing stock, basically stocks and bonds. And then we have financing outflows. That includes things like payments of dividends to shareholders or the repurchase of common stock. Sometimes businesses will increase their overall value by repurchasing common stock that they have earlier issued. When the company repurchases shares of common stock, we call that treasury stock on the balance sheet. Sometimes you'll see treasury stock on a balance sheet and be like, "Oh, what is that?" Yeah, that's what it is. It's what happened is the company repurchased shares of common stock. When that happens, it turns into treasury stock. And another outflow would be the repayment of a long-term liability, like a loan that the company took out. From operating activities, cash flow comes from the day-to-day operations of the business. Cash inflow, sales of merchandise or services. Outflow, we're paying our day-to-day operation bills, right? There are two methods that the company can use in the reporting of operating activities to help the business to understand how their cash is being used for day-to-day operations. The two methods are the direct method and the indirect method. Both methods result in the same amount of cash. But the reason why the companies do this is because it helps the business to better understand their cash flow by either breaking it down or consolidating it. So, uh, as a business owner, I prefer the direct method because it shows us how the exact level of detail of how the cash is being utilized. So, for example, the direct method reports the operating cash inflows and outflows like this. We see cash came in from our customers for sales. Then we have cash going out from the purchase of inventory. We have cash going out for operating expenses, interest expense, and income tax expense to get to our net cash flow for operating activities. The reason why I like the direct method is because it's simple. It's very simple to understand. You have cash coming in from your customers minus all of your cash outflows equals your net cash flow for operating activities. Very, very simple. The indirect method is a little bit more complex, and I'll show you what that looks like here in a second. Okay, the indirect method. The indirect method from operating activities begins with the net income from your income statement at the bottom of your income statement and adjusts the revenues and expenses that do not involve the receipt of cash. So you take your net income, you make adjustments to reconcile net income to get to your net cash flow from operating activities. You can see that this method is a lot more difficult to utilize than the direct method is. The reason why users will calculate the indirect method is because it takes well, it actually probably takes a little bit more time, but it conceals the day-to-day operations. Advantage of the indirect method is that it reconciles from the net income. But aside from that, I mean, in my opinion, that's really the only benefit. I prefer the direct method much more. But you can see from this comparison and this example, we have direct method and indirect method side by side. While the cash received from customers minus your expenses equals your net cash flow for the direct method, we can see on the indirect method, we have our net income, which comes from our income statement. plus the increase in accounts payable, balance sheet, minus the increase in inventory, balance sheet, equals the net cash flow from operating activities. You realize it's the same amount for the direct method and the indirect method. And that should always be the case anytime that you're utilizing one of these two methods in the statement of cash flows to calculate the net cash flow from operating activities. Any questions? It makes sense, right? Hopefully. Okay. Same concept applies for investing activities. Investing activities, as we discussed, is the purchase or sale of property, plant, and equipment using, cash. You take your cash inflow from investing activities minus your cash outflow for investing activities to equal your net cash flow. Cash inflow minus cash outflow equals net cash flow for investing activities. Very, very straightforward. What about financing activities? Financing activities, as we discussed, includes the issuance or repayment of stocks, bonds, or debt, right? And the way that the statement of cash flows works for that is very similar to the investing activities, where we simply take our cash inflows minus our cash outflows to get net cash flow for financing activities. So the direct or indirect method really only applies to operating activities. We talked about that. Let's talk about non-cash investing and financing activities. Once in a while, you'll run into something like this. Company might enter transactions involving investing and financing activities that don't have any effect on cash. An example of this would be a company may issue common stock to retire its long-term debt. So what do you mean, Dr. B, right? Well, here's once in a while, instead of the company having a loan with the bank, the company might say, hey, listen, bank, why don't you just take part ownership in the company through common stock instead of me repaying the rest of that debt? That once in a while that happens. In fact, we find it happening a little bit more frequently in some industries than others. But for example, the cruise ship industry, that happens quite frequently, where common stock will be replaced, will replace a long-term debt, like a bond or some other type of security. So because this transaction indirectly affects cash flow, it's reported in the separate section that usually appears at the bottom of the statement of cash flows. It's kind of like a note, right? And you learn, I'm sure that some of you probably already discovered that in reviewing the 10K statements for your respective companies. So here's a nice visual representation of the statement of cash flows. Top is operating activities, then investing, then financing, and then the net change in cash. And then at the very bottom, you have non-cash. Nice and easy. That is the statement of cash flows. Any questions at all, statement of cash flows, before we get into the real fun stuff with a whole bunch of ratios and exciting, very thrilling times for financial statement analysis? You all can still hear me, right? I just want to make sure. Yes?
We can hear you, sir.
Thank you. Wonderful. Thank you, Ryan. I appreciate the affirmation. Sometimes I don't know if it's just me talking to myself. Thank you. Okay, financial statement analysis. It is super important for managers and other users of financial statements to understand the overall financial health of the company that they're looking at. As an investor, I like to look at the 10K statements like you all are doing for your project. I like looking at those because as an investor, it helps me to get a really good understanding of the overall financial health of the company. And when I'm doing that, I calculate a couple of key ratios to help me to better understand the financial health of the company. There are three determinants, three methods of evaluation that I look at when I am calculating ratios. The three are liquidity, solvency, and profitability. Liquidity, that's a fun topic. What does it mean to be liquid? Liquidity means I can quickly convert my current assets, like inventory or an investment, into cash. Into cash. Okay. We call on the sometimes on the balance sheet under current assets, you'll find this line item. It'll say cash and cash equivalents. Cash equivalents. When you see that, it typically means that the company holds a security or some type of investment that can be quickly converted into cash. But the word liquidity means how quickly can I turn something into cash? Basically. Solvency is the next one. Solvency tells me the company's ability to repay its debts. That's solvency. If the company has the ability to repay all of its current debts using its current assets, the company is considered to be solvent. We'll talk more about that. And profitability. Very important to be profitable. That's how businesses stay in business. Okay. Profitability is determined by, of course, revenue minus expenses. Yeah. But we can also look at profitability from a couple of different angles. We're going to talk more about that as well. So liquidity. Why is it important to be liquid? You might wonder. Well, from a creditor's perspective, we look at bank will look at liquidity to determine if the company has the ability to repay any short-term loans. From an investor's perspective, I'm interested to see what the company's ability is to pivot in an environment. Liquidity, that's where liquidity for me comes to be important. We're also looking at the company's ability to convert other current assets into cash. How do I know if the company has the ability to be liquid, you might ask? Well, the way I would do that is by computing a couple of different ratios. Here on this list, you're going to see 7 different ratios. Current position analysis ratios. Current position analysis ratios tells me where the company currently is in terms of relevant liquidity. Relevant liquidity. We call these, well, they're all current ratios, if you will. But what they do is they tell us the current position of the company, the company's current financial health. We also look at things like accounts receivable ratios. Accounts receivable, as you know, is the company's right to a customer's debt, right? What does it mean? Accounts receivable means the customer purchased the goods from me and I delivered them, but the customer has not yet paid me. So it created an accounts receivable. I expect to receive cash from my customer. That's an accounts receivable, right? And so we calculate these things called the accounts receivable turnover and number of days of sales in receivables. Basically, what I'm looking for in accounts receivable analysis is how quickly I can collect the receivables, the cash from my customers, right? That's the idea. And I'm also interested in inventory. For a merchandising company or a manufacturing company, I'm always interested in inventory. Inventory also tells me how quickly I can convert my inventory into cash. How fast can I sell my inventory? So we'll look at inventory turnover and number of days of sales in inventory. So here are the ratios. Here are the first three ratios, the current portion ratios. Okay. First one is working capital. Working capital tells me how much cash or how, yeah, well, in theory cash, but what is my position? How quickly can or how can I grow my company? Is basically what working capital is. Working capital. This is cash that can be used to reinvest into the company to purchase additional inventory, or cash that can be used for another capital project, like or an investing activity, something like that, right? So working capital, it's a very simple formula. You take your current assets minus your current liabilities. Remember, current assets and current liabilities are both found on the balance sheet. Current assets minus current liabilities tells us the company's working capital. The second ratio here is called the current ratio. The current ratio is a ratio that tells me the company's ability to pay its current liabilities. The current ratio, very, very simple ratio. How do we compute it? We take the current assets divided by the current liabilities. Current ratio, current assets divided by current liabilities. That's the current ratio. Again, it gives me a good idea of what's the company's ability to pay its debts, right? The higher the better. Higher the better. Next one is called the quick ratio. The quick ratio measures the instant debt paying ability of the company. How quickly can it pay its current debts? That's why we call it quick. How quickly can it pay its current debts? We perform the quick ratio. That is quick assets divided by current liabilities. Oh, I can already hear you now. Dr. B, what's a quick asset? Quick assets are cash and other assets that can be quickly converted to cash. Those are quick assets. They typically include things like cash, temporary investments, and accounts receivable. But they do not include inventory or prepaid assets. We do not include inventory or prepaid assets in quick assets because inventory is not quickly liquid. We cannot quickly sell our inventory in a fire sale. Okay. And prepaid assets, it usually takes some time to get a refund, right? So that's why those two things are not included in quick assets. Those three ratios are your current portion analysis. The other ratios, we're not really going to get into those for this course, but just know what they are, and you'll be able to actually read a little bit about that in the learning materials for this week. Next area is solvency. I mentioned about solvency earlier. Solvency is a company's ability to repay all of its debts over time. I'm interested in solvency because if a company has the ability to repay all of its debts, that means the company is solvent. It's solvent. The solvency is super important because it tells me that the company has enough assets to cover all of its liabilities. Not surprisingly, that's not the case for a lot of the larger companies. How do we analyze solvency? What are the ways that we can analyze solvency? There are three primary ratios that we use to analyze solvency, or the company's ability to be solvent. First one is the ratio of fixed assets to long-term liabilities. The way it's calculated is we take fixed assets divided by long-term liabilities. Fixed assets, as you know, that's property, plant, and equipment found on the balance sheet under assets, right? And then long-term liabilities. Those are your long-term notes payable, also found on the balance sheet under liabilities. Next one is the ratio of liabilities to stockholders' equity. To find this, we take total liabilities divided by total stockholders' equity, both of which found on the balance sheet. The last one here is called times interest earned. We take our income before income tax plus interest expense divided by interest expense. You're probably wondering, Dr. B, where can I find these things? Times interest earned items are found on the income statement. Income before income tax, you'll find that at the very bottom, toward the very bottom of the income statement. And you'll also find interest expense on the income statement. That's solvency. What about profitability? Everyone's interested in the company's ability to be profitable. Stockholders, investors, managers, we all want to make sure that our company is profitable. So how do we do that? We focus on the company's ability to generate sales, to generate earnings. This is called profitability. To analyze profitability, we look at the company's ability to generate future sales. Future sales. We look into the future. This is a forward-looking analysis. Profitability is. The ability depends on the relationship the company's operating results and assets the company has available for use. I said earlier that the property, plant, and equipment, which are fixed assets, the company utilizes those fixed assets in order to generate sales. So we're going to look at the company's ability to utilize those assets to generate sales. And we also look at the relationship between the income statement and balance sheet. There are several of these ratios. You don't need to know them all. It's just good to understand how they work. Okay. The asset turnover ratio. This tells me how quickly I am turning over my, well, in this case, really we're looking at how quickly I can turn over my, what's the word I'm looking for? My inventory, if you will. But there's another ratio for that, but how I'm utilizing my assets, right? In order to find this, we take our total sales, total revenue, right? Divided by, you find that on the balance sheet. I'm sorry, the income statement. Sales is on the income statement. Sales is on the income statement. That's total revenue. Take your total revenue divided by the average total assets. When you hear average total assets, remember the word average. When we're talking about average total assets, we're talking about your assets divided by your total assets divided by the average number of assets. This excludes long-term investments. Sales divided by average total assets. Next one's return on total assets. That's net income plus interest expense divided by average total assets. The net income and the interest expense found on your income statement. Average total assets, you take your total assets divided by the average in order to get average total assets. That comes from your balance sheet. Then we have return on operating assets. We take your operating income found on the income statement, divided by average operating assets. Average operating assets, these are your property, plant, and equipment. Okay, a few more profitability ratios. Return on stockholders' equity, take your net income divided by average total stockholders' equity. Return on common stockholders' equity, take your net income minus preferred dividends divided by average common stockholders' equity. And then EPS, earnings per share. This one's a good one. I like earnings per share. As an investor, I like earnings per share, right? You take your net income minus your preferred dividends divided by shares of common stock outstanding. You'll be able to find preferred dividends and common shares of common stock outstanding on the balance sheet under equity. A few more. Price per earning PE ratio. PE ratio. You'll typically hear this on this is more finance stuff, but it's good to know. Take your market price per share of common stock divided by earnings per share of common stock. Market price per share of common stock, you'll be able to find that at the close of the trading day. That's the stock symbol, yeah. Divided by earnings per share of common stock. Dividends on common stock divided by shares of common stock outstanding, and then dividend yield. Dividends per share of common stock divided by the market price per share of common stock. Market price, again, found at the end of each trading day. Those ratios really, they really only work for publicly traded companies for the most part. Okay, how do we analyze financial statements? You might be asking. There's a couple of different methods that we can use to analyze financial statements. In analyzing, we're talking about examining changes as an expression of percentage or total dollar amount across certain periods of time. We can use analysis for that, or we could also use ratios that express the financial statement expressed as percentages, or other methods to measure economic relationships. The idea behind analyzing financial statements is for management and investors to better understand the financial performance of the company. Performance. We're looking at performance measures when we talk about analysis. Through analytical methods that we examine for the performance of companies, there are three primary methods that companies utilize to better understand their overall performance. One is the horizontal analysis. Second one is the vertical analysis. And the third is common-sized financial statements. So think of the term horizontal, vertical, common-sized. Horizontal means across. We're comparing the same line items from period to period. Vertical, we're comparing the line items expressed as a percentage up and down. And then common sized, we're expressing it as percentage and comparing the company to another company. We'll talk about that. We'll talk about each one. When we analyze financial statements, we're looking at the increases and decreases expressed as a dollar amount and as a percentage in comparison. This is called the horizontal analysis. Each item of the amount expressed is compared to the same or earlier statements. So, in other words, I'm looking at year to year, 2020 to 2019 to 2018. I'm putting the financial statements side by side, okay? 2020, 2019, 2018. I'm looking at the performance of each year for each line item on the income statement balance sheet. And I'm looking at it as expressed as a change in dollar amount and as percentage. So when you calculate the percentage, you use the base year. Okay. So I'm going to show you how do we do that. So here's an example of the horizontal analysis. Here we're comparing two different years. You see on the very right side of this of the balance sheet, we see increase, decrease in amount and percentage. So, for example, total assets. We have a decrease of total assets of $91,000. How do we get there? We took 2016 minus 2015. 2016 minus 2015 to get us to the change in dollar amount. So 2016 minus 2015 to get the change in total dollar amount. And it's the same formula for every line item. The new year minus the older year equals the change in dollar amount. Okay, so that's dollar amount. Now, how do we get the change in percentage, you might be asking? Here's how that works. You take the new year minus the old year divided by the older year. So, for example, current assets, 550,000 minus 533. That's guess what? That's 17 divided by 533. So 17,000 divided by 533 is 3.2% or 0.032. Then you just multiply by 100. But that gets you that's what we call the percent change or delta change. So delta is change, right? So the way to think about this is, how do I get percent change or percent delta? I get that by taking new minus old divided by old. New minus old divided by old. But remember, you have to do that top part first. So think that there's the invisible brackets are there. Order of operations, right? So you take care of the subtraction before the division in that equation. Open bracket, new, minus old, close bracket, divided by old. So 2016 minus 2015 divided by 2015. That gets you your percent change. And that's horizontal analysis. Let's talk about vertical analysis. Vertical analysis is where we express everything as a percentage and we compare it to other items on that financial statement. We usually do this for the balance sheet and the income statement. On the balance sheet, we express everything as a percentage of total assets. On the income statement, we express everything as a percentage of total revenue. So here's how it works. So on the balance sheet, we express everything as a total percentage of total assets. Okay. So, and we do that for each respective year. So total assets is 100%. Current assets is 48.3, long-term 8.3, property, plant, equipment 39%, intangible assets 4.4%. Okay. How do we figure that out? You might be asking. Well, it's very simple. We take our current asset amount divided by total assets. 550,000 divided by 1.139 million is 48.3%. We would do the same thing for each item. Not long-term investments, 95,000 divided by 1.139 million, that's 8.83%. I'm sorry, 8.3%. Property, plant, and equipment, 444,500 divided by 1.139 million equals 39%. So forth and so on. You see what we're doing here. You do the same exact procedure for liabilities and stockholders' equity. Current liabilities, 210,000 divided by 1.139 million equals 18.4%. So forth and so on. You do it for each line item. Now, here's the interesting thing. Just like the balance sheet, assets equals liabilities plus equity. We see that through vertical analysis, total assets, which is 100%, equals the total liabilities and equity, which is also 100%. That's how you know it's correct. Is when you have total assets and total liabilities and equity being the same. Good so far. Okay. Common size financial statements. We use this to compare our company to other companies in the same industry. So you might have a company in your 10K for your 10K report. Let's say you have Northrop Grumman, okay, is the company that you selected. Well, you might be interested to compare Northrop Grumman to L3 Harris, which is also another government contractor in the same industry. So you might say, hey, you know what? I want to compare those two companies. How do I do that? By looking at different financial statements. Well, Northrop Grumman reports in millions and L3 reports in thousands. And that's kind of confusing. So I'm going to do this thing called common sized financial statement analysis. It's where we compare one company to another in the same industry to better understand industry averages and, of course, to also value the company against another in the same industry. So here's an example. We have Lincoln Company and Madison Corporation. They're in the same business. They both sell textiles. So here's how it works. We express everything as a percentage of sales on the income statement. On the income statement, expressed as a percentage of sales. So sales is at 100%. So we would take the cost of goods sold amount divided by sales, 69.6%. Gross profit amount divided by sales, 30.4%, so forth and so on. We do that for both companies. Then we can compare the two companies side by side to better understand how the companies are performing against each other. Fun, right? That's kind of cool. It's good to do that type of analysis when you're looking to invest in a company and you're trying to decide between one or the other, or if you're interested to see how your competitor is performing against your company. And that, my friends, is the end of this week's presentation. I hope you learned something from this. Are there any questions that I can take from anyone in the room? Anything at all?
Dr. B, I have a question.
Yeah, go ahead, Ryan.
So for the reading assignments for this week,
yeah,
I know that before the schedule changed, we had chapters 3 and 4 as one of our required reading material.
That's right.
I'm not sure if it's there anymore.
It's not. It changed slightly. The chapter 3 and 4 are actually going to be covered in, I believe it's in week 3 now.
Okay.
Yep. So I apologize again for that situation. The university recognized a couple of errors in the materials, so we had to go and change weeks 2 through 8 for accounting 221. And of course, what happened is that we found some problems with the homeworks as well, where they were located in the wrong places. So we want to make sure that our students have the highest of quality resources available, being an open educational resource institution. And because we had to go through that process, we had to kind of adjust and realign a little bit. So I apologize for that.
Okay, thank you, sir.
Thank you. Are there any other comments, questions, concerns that I can help to answer for week 2 at this time? Anything at all? Okay. Otherwise, you have my cell phone number. It's on the syllabus. If you ever want to get a hold of me that way, you also have my email address. I do get quite a few emails on a daily basis, but I'm always very quick to respond to my students. I have my phone with me at all times. So please email me, or you could also contact me through the classroom in the discussion forum. Anytime you have a question, comment, concern, you just let me know, okay? I am here for you 100% of the time. So I want to thank all of you for your time today. I appreciate you taking time out of your busy days to be with me. And I hope you all remain safe, stay washing your hands, all of that good stuff. Thank you so much. I appreciate your time.
Thank you, Professor. Thank you.
You're welcome. Thank you so much. I appreciate all of you. Have a great night. Take care.
Thank you.
You too.
Thank you.